Hello, everyone. Welcome to today's session. Let's get underway here. We'll start out with S&P 500. We've got a little bit of a down day here, 1.5% or so. Feels a lot worse than it is for whatever reason. Probably just because we haven't had a move like this in a long time. We had a small one back here. We had a small one back here. And even a couple others here and here. But really, since last fall, October, November, we really haven't seen any kind of a downturn at all. So this is feeling a little bit new, I think. And so let's talk about a couple of scenarios. Number one, we know that markets don't go up forever. We know they don't go down forever, but they do stop a trend and retrace a trend. And so we're going to talk a little bit about risk, talk a little bit about allocation, talk a little bit about hedges, talk a little bit about volatility. Pardon me, and try and squeeze all that in a half hour here and cover, probably just some broad topic ideas, because there's lots of different variations on volatility and management of that volatility and portfolio management and trading in and of itself, and number of holdings and cash, and there's a lot of dynamics to that, and a lot of ways to be able to do that. And so we'll cover some of those things. But let's talk about market conditions here first and foremost. We've got we're still bullish in this bull market. This is the chart here, this line of the S&P 500. This is our combo chart of sentiment, momentum, and breadth. When we have sentiment here, we have momentum here, we have breadth here. So we've been in this really long upturn. This last little push higher here, we saw momentum have this spike. Sometimes it will spike up above sentiment, but in this case it hasn't. But we do have this setting of sentiment, momentum, breadth. This is still a bearish setup right here, where we start to see that, and we think about what's happening here. When you have sentiment, this is the complacency. This is kind of the fear and greed type indicator, where there's just no fear yet. There's still complacency and or greed. You can use those two terms interchangeably, greed and complacency. Essentially, that there's just no selling happening or anticipation of selling. The blue line is related to the volatility index, which is essentially the implied volatility of S&P 500 put options. And so when it moves, you're seeing spiking in put option activity on the S&P 500. And we're just not seeing, at least as of yesterday. It might spike a little bit today with today's move, but still relatively early stages of this. So, and this is just a natural part of market conditions. When we have this move here in the S&P 500, we get a retracement. Now we've had this upturn. Now we're going to get some kind of a retracement. What is that going to look like? Is it going to be like this? Is it going to be sideways? Is it going to be a deeper retracement? Is it going to be a complete reversal and head back down? Obviously, I don't know. Obviously, that's, the market is going to do what the market does. What we've got to try and do in terms of our investment strategy is be able to participate in as much as we can in the upside, reduce risk on the downside, or even potentially profit from the downside. And these edges, I call it trend, and that is these upper ranges. When we start to see extremes at these upper ranges or these edges of the trend, then we typically get some kind of a pause. It doesn't necessarily mean the trend is over, but we get this spike here. That happened back here. Now we're seeing the kind of this momentum effect, and then some divergence starting to happen here on the momentum indicator. Is that momentum? Yeah, it is. And breadth as well. Breadth is just has been going higher. What that simply means is that there's just not a large participation in this rally. There is, S&P 500 is what it is, and it's become, it's a weighted average. So you can have larger cap companies that are controlling the vast majority, and I don't know the exact number, but I think I had heard it's about 25% of the actual S&P movement is from the top 10 stocks. So you're getting a lot of, it's becoming less and less of a true indicator of the market because it's so heavily weighted in the Mag 7 stocks. So that being said, we can look at some other additional indicators. Not that it always helps. S&P is a pretty broad indicator, and for the most part, we're looking for the trend direction, and we're looking for the edges anyway. That's kind of all we're looking for. And now what we're starting to see is when we start to see momentum pushing higher, and the vast majority of stocks, or the bulk of the trend of the market participants starting to trend lower, that's an indication that this trend is starting to weaken. There's not as much participation. It's not going to be able to be held up as easily. So these cracks that we're starting to see can happen pretty quickly. Let's look at buy-sell ratio. This was one actually that was kind of interesting here because we've been hovering around that +1, -1, just right around this range now. And so now we're back to the positive right here. This could adjust. This is as of end of day yesterday. Certainly could adjust with today's movement as well. But it's, this is kind of representative of what we've seen in the last month or so of the market, and that's just this slight trending higher. Not, breadth is relatively flat, but you're getting some of these mega cap tech stocks that are just pulling the market higher, and we'll see how long that continues. Okay, the overall indices, there's a couple of things I wanted to look at here. One is just the bond perspective, because the bond perspective is still important. Remember that when bonds are dropping, that interest rates are rising. So, and really the last 18 months to 2 years have been talking about interest rates, talking about inflation, talking about really those two things, because the Fed is trying to manage inflation, and they're trying to do that by manipulation of the interest rates, raising the interest rates, lowering the interest rates. And the bond market obviously is its own free-flowing market, and it can make its own decisions in terms of what it also believes the Fed might be doing. And as of now, it's just not, it's not convinced that the Fed is going to be raising or lowering interest rates. And so we saw this push back down here as bonds are moving lower. Interest rates have been just kind of steadily moving up or relatively flat, and we'll see what that turns into if we do see some support levels right here on bonds, and if it ultimately starts to stabilize and create some new uptrend. Let's look at a little bit longer term chart. The 1-year time frame is still a downtrend. And so we had this big rally here. It could just still be a counter trend to more downside to come in bonds, and that's certainly a possibility that inflation can't get under control, and or we run into a recessionary situation where the Fed may need some ammunition to be able to lower interest rates if there is a recession. So in fact, I watched a thing with Powell the other day. I think it was just like a 60-minute soundbite on YouTube, and that was one of the things he was talking about was we need some ammunition in case there is an economic slowdown as well. So the Fed's dealing with a couple of things, and those just have to do with inflation and economic growth. The market has really just been really had a massive run up because of this perspective and because of this anticipation that the Fed's going to be lowering rates. And so if the market starts to believe that the Fed can't or won't lower interest rates, then it may give back some or much of this most recent gain right here in terms of S&P 500. That 1-year time frame too, you can see today's just a little blip. It doesn't feel like much, but it certainly could be the early stages of retracement, and we could retrace all the way back to that 475 on SPY and still be in a really solid bull market, still be in a really solid uptrend, even if we were to retrace all the way back down to this support. This is essentially a breakout point as well, or very close to it, where the market's S&P 500 broke out above this level and is now looking to either continue this overall uptrend and certainly retrace and ultimately moving higher. It's an interesting time right here for markets as a whole. Now, that being said, determine, allocating and discussing market conditions and how that affects overall performance in a portfolio it can be all over the place, because it really depends on what your overall strategy is and what your goal is for your strategy. If it is, I'm trading, I'm shorter term, I'm using less positions, versus I'm a little bit longer term, I'm holding multiple positions and I'm managing those positions one by one. And that's essentially what we focus on primarily, is portfolio strategies where we're managing trades, individual stock trades, and we're focusing on those current trends, and then capitalizing on winners, stop losses on losers, and not making sure that our position size is at a comfortable level, and so that we're not taking on too much risk. Now, as we started to climb right here, one of the things that you can consider, and I've mentioned this before, is inverse ETFs. So, and I mention that because it's just a really easy instrument to use to set up a hedge, or to capitalize or profit from a downturn, from this down. Markets are going to retrace. The question is, are we done with this rally? Are we done with this uptrend? Let's go out to 2 years and see what that looks like on this time frame. Maybe not. Maybe it's not going to let me do that here as of right now. And that's okay. We'll skip that portion. But this overall uptrend, this last 2 years, we bottomed out. We bottomed out in October of 2020. What are we at for 2022? And had this, this was last year, retracement, and then we've just been moving higher ever since the fall. It's due for a retracement counter trend. Still getting lots of good numbers, economic and profitability numbers here as well. Let's look at sectors. Sectors are also showing a little bit of strength. We saw 3 of these in downtrends, all had sales. It was real estate, utilities, energy, and those are starting to at least move back up. They've got some short-term uptrends here, and let's take a look at this in the shorter time frame. Utilities. So utilities potentially finding some support right here. It's been retracing, and so we definitely have seen some of these sectors that haven't participated in this rally. We've seen energy also retracing back down. This is becoming a little bit more of a bullish pattern as we look at oil as well, and looking at USO starting to strengthen in this overall uptrend. It had this uptrend retraced, and now it's starting to just find some additional demand right here. So there could be some sector rotation over into other things, energy, which has been weak, moving back into that as equities potentially start to retrace right here as well. So really, that's kind of the major market players. We've got gold, which is also retracing right here. This has been sitting right on this shelf, this 185, 186 range, and looks like it also wants to pull back just a little bit here as well. So we could see, who knows what we're going to see in the next few days and weeks, but we are seeing markets at a high. We're seeing some participation actually come back in with that buy-sell ratio. And we may see, what I'd be interested in to see if we get continuation of this selling to the downside, or if we start to get some buying on any one of these days, whether it's today, or if we get some continued selling tomorrow, or if we get that flush that everybody's kind of waiting on right here, just to get a dip, to get an opportunity for some support. We'll see, but we're in that upper end of that range and could see some volatility here for sure. Let's look at, so let me jump over here and talk about, just for a minute, again, one of the ways to hedge is to be able to utilize an inverse ETF. There's a lot of them, but there are really 2 core that you could utilize. You could even use a non-leveraged ETF. These are leveraged 3x, and it works nicely for a hedge because you do get a little bit more volatility in these. You can see what's happening on this today. So here's an example then of markets are dropping. This is going to go higher, and it also could move back up to this range. So S&P 500 and NASDAQ just like they were in this upper range here at the top of that momentum zone and could retrace, this could rally up into this area as the market is doing that. So it's opposite. It's like a mirror image, and it's also leveraged. So one of the ways to be able to potentially capitalize or hedge, and what I mean by a hedge is simply I don't want to sell any of my positions. If I'm in that boat, but I also don't necessarily want to just watch them move lower and get stopped out and or whatever the case may be. If I want to be able to have some way to profit from that, then this is a really easy way to be able to do that. One way to do that is with some additional cash that you may have. So for example, the new buy daily portfolio, we've got about 45% in cash. And so we could take a portion of the cash available and whatever that allocation amount it is, a little bit larger chunk, 5% maybe even up to 10% or 7% of that cash, allocating that towards an inverse ETF as well. And then also tightening up the positions in terms of exiting losers or stocks that look like they're just not going to work. We've got a handful of those in here now that are they've just been volatile. Some of them we entered early. IoT, this is one that entered here, rallied, immediately retraced, is creating some volatility right here. Our stop loss is down in this low point though, but if it comes to a scenario where you start to feel like I have too big of a, I have too much, I have too big of a position, I want more cash and I want less holdings, then how to trim, right? How to start to trim those portfolios. And there's really two ways to do it. One is start to pick which one of these losers you want to sell, or maintain that initial stop loss, knowing that that's probably what's going to happen. So that's one of the ways, is just start to sell some of these stocks. The hard part with that is sometimes early on in the trends, you're down. Okay, like MARA, that was the initial trade today. It's had a big run up. It could certainly have some volatility back down again, but I'm willing to have some volatility early in those trends to try and jump back in something like a stock like that. Okay, we're starting to see momentum shifting into other trades, and that's okay. Okay, so the other thing is starting to pare back the winners, or to realize your gains, or to harvest your gains, or to lock in your gains, whatever terminology you want to utilize. And so one of the things we've done today, in fact, OSCR is starting to reduce the overall position size. And I've mentioned that in this class before, is the way that I prefer to do that is if you have a holding that is becoming a larger position inside of your portfolio. This is showing portfolio allocation at 2.87. I've already adjusted these other ones, so it's not going to give us a great example, but you can see 2.68. Let's see, here's NPCE. We also did that one today. It was up around 3.5, I think 3.4, maybe a little bit higher than that. But we had a big enough gain in this that I moved it back to that 2.5%. So as we have continued winners, so here is NPC, as we have stocks moving higher and we have gains in those, we can start to sell some of those winners as well. But we don't want to sell the entire position, because this, there may be nothing broken with this position yet, but we also want to lock in some of the gains. So instead of setting a target to take the gains with a portfolio model, it is based on percentage allocation. Okay, so that's going to be different for every portfolio depending on how it's built out, because you may have it may not have had a run, or you may not have had that trade, and so you're starting out with a different group, and so those two things in terms of allocating, to say I want to shift to 50% cash. How am I going to do that? Okay, which of these am I going to sell? Those are going to be the places that I'm pulling from. I'm going to be pulling from positions that have gains that are larger than 2.5%, and and losers that don't look like they're going, that maybe we've had them for, BLND is playing with us right here because it is also, this was our entry bar. Right here was the entry bar, and it's rallied up, it's rallied down, it's rallied up, it's rallied down. It's holding right here on this area, but and the stop loss is going to be just below this, I believe. In fact, let's go double check on that and see what that stop loss actually is. If I had it, I've already forgot the symbol now. Oh yeah, BLND, and we are looking at BLND 240, right? So 240, yeah, just sitting just below that. So this is, this becomes a decision to say, this thing is just, it's had its shot, or is this still a consolidated phase? Is it going to start to push higher? I'm willing to hold on to that right here, just to see. It's already close enough now. The stop loss is relatively tight. We already planned on it, right? That's a part of setting up the trade, is we already had adjusted for any kind of risk that we're willing to take. That evolves. I get that. I get that, things change. We're looking at, start to see some volatility that hits the gut a little bit, and it's like, oh my gosh, what am I going to do right here? How am I going to reduce risk? If I want to reduce risk, how would I go about that? Then you can simply do nothing and see which one of these do get stopped out, because they might not. They might surprise us. What we want to be in charge of is, we want to be in charge of our risk. The market's going to be in charge of our reward. We have to be in charge of risk, and make sure that we are not taking too much risk. And that can just simply be the number of holdings that we have, the size of the holdings we have, the stop losses that we have. And this is a good time to be able to make that decision. I'm comfortable with this. As of today, we set up a couple new trades, and not quite willing to make any adjustments. I'd like to see how we close out the day here in the next hour and a half, and then look to see what tomorrow looks like as well. Only because that S&P 500 is still in this upper momentum range. If we get a couple of aggressive days down, then what I want to start to see is which stocks in the new buy list are starting to gravitate to the top. Today we had a bunch of Bitcoin miners, so we're seeing. So we added MARA. It's down, it gapped a little bit lower from that entry, but it had 2 or 3 days of really big upside. BITF, same story right here, really similar chart pattern. Same with IREN. They just really didn't have a chance to pull back at all. So in these kind of trades, being able to make an adjustment for, I want to get into this trend. We get a little bit of FOMO, for example. It's like, this thing is starting to move, or it's a rotation to shift into some of these other type of stocks or industries. So we want to keep an eye on these new buy list and get a little bit better idea of what might be, where that money might be flowing to as it's moving out of maybe large cap S&P stocks. Where is it going? Because there's still going to be opportunities even in a retracement or a pullback. We just want to make sure that the amount of volatility that we're dealing with in this portfolio. So we were at 32, a little bit above that yesterday, so down 2.5% roughly on today. So a little bit more of a downside than the market as a whole, but that's kind of the nature of the portfolio. We're going to have a little bit more volatility both to the upside and the downside. Okay, let me see. Let me just go back, just summarize a couple market conditions. That buy-sell ratio, keep an eye on that one, see where that one closes out today, and then spend some time going over the portfolio and deciding how, where your risk level is, where you're comfortable. I want to raise some cash. I want to go with an inverse ETF for any potential hedging for some downside, or I want to just do both or do all three. I want to sell any losers that I've got that haven't been working for the last few weeks and look like they may not work, and they're continually approaching a support area, or even a hold signal, or even working over to a sell signal, and or realizing some of the gains on some of the winners as well. That's what I would be focusing on this week, is looking at where's the overall risk in the portfolios, how much cash are you comfortable with, and how many holdings do you actually want to be having, those winners, paring those back, adjusting the percentage allocation, and making it a portfolio that you're comfortable with, and that aligns with your risk tolerance. That's the most important thing, is the risk tolerance, because volatility happens. It is just what happens in equities, in the stock market. That's just a part of of the trade-off, is we're dealing with volatility and risk in the trade-off to try and grow our capital at a better rate than we can in a savings account or a fixed type of interest rate. I'll end on that note. Thanks everyone for your time and effort. I appreciate you for that, and we'll see you next time. Thanks a lot. Bye now.